Hi everyone, my name is Jay Krishnan. I am one of the senior partners of HLB HAMT. Today we are going to discuss about special purpose financial statements for corporate tax purpose. We are all hearing the consolidation of financial statements, combination of financial statements, standalone financial statements. These are all for IFRS purpose, International Financial Reporting Standard purpose. Now we will be discussing about a special purpose financial statements, which is meant for corporate tax. Corporate tax law introduced from 2023 July onwards. The corporate tax law is in place in the country. So we are going to discuss about the scenario or some circumstances where the consolidated financial statements are prepared for corporate tax purpose. Technically, these are the special purpose financial statements.
Hi everyone, myself Vimal, Director for the Accounts and Advisory Division at HLB HAMT. I'm a chartered accountant from India and been with HLB HAMT for the past 15 plus years. My area of expertise mainly includes accounts and finance, audit and taxation. So here first we have to understand that there is a difference between consolidation and combination of financial statements. Consolidation under IFRS can only be done if an entity controls another entity. Similarly, consolidation under corporate tax law can only be done if the entities under the group satisfy the condition under all the conditions under Article 41 of the corporate tax law. On the other hand, two or more entities can prepare a combined financial statements if they are under the common management, even though the control does not exist. Now here it is very important to know the definition of control. As per IFRS 10, a control would mean or a control exists when an investor is exposed to or has right to variable returns. He has the ability to affect those returns through his power over the investee. So if these all conditions are satisfied, we can say that the investor has a control over the investee, and accordingly he can consolidate the financial statements of the investee. Now we are going to discuss about what are the procedure for consolidation of financial statements. So once a parent subsidiary relationship is established, parent can consolidate the financial statement of the subsidiary. So this can be explained in three simple steps. Step one would be to combine the like items of assets, liabilities, equity, income, and expenses. The second step would be to offset or eliminate the carrying amount of investments in parent's book with the corresponding equity portion in the subsidiary. Or the last step would be to eliminate in full the intra-group balances and transactions. So with that, Mr. JK would like to ask, what are the scenarios under which a combination of financial statements or a special purpose financial statement is required, even though the tax group cannot be formed?
Okay. Adding to what Mr. Vimal said, consolidation or combination of financial statements are quite common in UAE. For the corporate tax purpose, I will discuss, 5 specific scenarios, where we would be required to prepare the special purpose financial statements, be it a consolidated or a combined financial statements is a different question. So these are technically called special purpose financial statements. Number one, when an individual owner or a natural person owns multiple sole establishments in UAE. Mr. A owns 5 sole establishments operating in UAE. All these 5 establishments or sole establishments are considered as one entity for the corporate tax purpose. This is technically a natural person. For the CT corporate tax purpose, this is considered as a natural person or a single natural person. So all the entities, sole establishment or the business operating in UAE as a sole establishment should be consolidated and make it as one single financial statements for corporate tax purpose. So it can be different business, it can be different geography, whatever. But for the corporate tax purpose, all these sole establishment books of accounts should be consolidated and then make a consolidated financial statements. Number 2, there is a UAE parent company and then there is a foreign PE. Foreign PE in the sense it's a branch of UAE parent. And then there are multiple options in corporate tax law. To when you file corporate tax return, you can opt for foreign branch exemption or income inclusion in UAE and then file it. Options are there. So when you choose a foreign branch exemption, mostly the UAE parent entity should have a standalone financial statements, and then there should be a consolidated financial statements which include the financial results of the foreign PE. So UAE parent entity, when there is a foreign PE, and then when we choose the foreign branch exemption, there should be a standalone financial statements and a consolidated set of financial statements. By default, we prepare a consolidated statements, and then when certain options are being elected, then we can detach it and make a separate standalone statements as well. The third scenario would be when a limited liability company, a LLC company operating in UAE, owns another sole establishment in the country. LLC company A LLC owns another sole establishment in UAE. In this scenario, such holding is considered as an extension of the parent, or it can be considered that the sole establishment is considered for corporate tax purpose as a branch of the parent entity in the country. So automatically both the entities should consolidate the financial statements and then file for the corporate tax purpose, which means a limited liability company owning 100% of a sole establishment will be falling under mandatory consolidation of financial statements. Fourth one, a free zone. Technically, it's a qualifying free zone, owns a PE in the mainland of UAE. If it's a PE or if it's a branch, by default, we will be preparing a consolidated financial statements. But in case there is a scenario that, since the mainland entity is a separate PE and then free zone is a qualifying free zone, we have a tendency to prepare two sets of separate set of financial statements. It's okay. It can have two set of financial statements, but for the corporate tax purpose, there should be a mechanism of consolidation of both the entities' financial statements, and then one single consolidated statement should be used for filing for corporate tax purpose. And the fifth scenario is multiple branches, say branch A, branch B, branch C, operating in UAE. The parent is overseas. So all the branches, multiple branches operating in UAE with a common parent outside UAE. All the branches operating in UAE is considered as single entity for the corporate tax purpose. So eventually or automatically we should consolidate all the financial statements of all the branches operating in the country with the different business or with the different line of activity. No matter, we have to consolidate and make one set of financial statements for the corporate tax purpose. These are the 5 scenarios where the consolidation or the combination of financial statements or a special purpose financial statements are required for corporate tax purpose. Having said this is a challenge, or is it a challenge or is it a role change? Is a question mark. By the introduction of corporate tax in the country, accountants are going through some role changes, or it's an additional responsibility as well. So now I would like to hear from you, Mr. Vimal. What are the additional role of an accountant since the introduction of corporate tax law, and also you can complement it by saying what are the challenges the accountants are facing in the country.
Yeah, thank you, Mr. JK, for the detailed insight. As rightly said, with the introduction of corporate tax in UAE, the role of accountants has become very, very critical. Starting from the registration for the corporate tax, maintenance of proper books of accounts, maintenance of proper documentation, ensure compliance with transfer pricing rules, and finally submitting the tax return to the authority. Now, as far as the consolidation of financial statements are concerned, the role of accountants are even more crucial. So let us discuss about what are the major roles and responsibilities of accountants with regard to the consolidation of financial statements. The first step would be the identification of entities. The accountants has to identify which are the companies that are part of the group and are eligible for consolidation. This information can be easily available from the tax group certificate. The second step would be to gathering of financial information. The accountant has to gather the required financial information like trial balances, individual financial statements, and other relevant documents to support the consolidation. So once gathering the financial information, the accountant has to validate the standalone financial statements, whether they are reported properly. So once the validation part is completed, he can proceed with the consolidation of financial statements. The consolidation procedure we already discussed before, aggregating of similar line items and eliminating the intercompany balances and transactions. The next step would be the determination of taxable income for the group. This exercise can be done by adjusting the net profit of the group, by adjusting the non-deductible expense and exempt income, if any. Then the next step would be to calculation of the tax liability for the group. Based on the applicable rates to the group, the tax liability of the group can be computed. And the final step would be to file the return and make the payment. So here the accountant has to ensure that the return is filed in time and the tax is paid to avoid any penalties, or to make sure that the compliance with corporate tax law is being made. Now we come to the what are the major challenges that are being faced by the accountants. So we already discussed what are the roles and responsibilities. Now coming to the major challenges, the first major challenge would be to ensure that the conditions that are mentioned in Article 10 are continuously met during the relevant tax period. For example, if any of the conditions under Article 41 are not met, then that particular member of the group has to exit and the parent has to consolidate the financial statements with the remaining members of the group. So that is a really challenging scenario for the accountants. Secondly, to prepare different set of financial statements for the IFRS and the corporate tax purpose. In that case, a separate set of financial statements, consolidated financial statement has to be prepared. Again, if the consolidated turnover of the group, tax group, is above 50 million, the group may have to do audit for two separate set of consolidated financial statements. So these are the major challenges with the introduction of corporate tax and the eligibility, considering the eligibility of the tax group. These are the major challenges that is being faced by the accountants for the consolidation of financial statements.
Okay, good information, Mr. Vimal. Mr. Vimal, so you are trying to say that now, since the introduction of corporate tax in the country, the accountants should have, two sets of financial statements. Sometimes say depends, one for the IFRS purpose and one for the corporate tax purpose. Because if the scenario, the circumstances demands, or there are some grouping is being done for the corporate tax purpose, or even if there is no grouping is being done, like earlier I mentioned, 5 scenarios. So one of the scenarios, if the entity is falling under one of the scenarios, as I discussed earlier, so they have to prepare two sets of financial statements. That is what you wanted to say, right? So this is the real challenge.
Yeah, that is a real challenge because it takes not only the effort but also the cost part also, because the cost also involved. That also we have to consider, especially when the 9 conditions that is mentioned under Article 41. Even if it is a single condition is not met for the whole relevant tax period. So that member has to be, that member has to leave out of the group and the parent has to consolidate with the remaining members. At the same time, they have to also take the approval from the FTA before consolidation. So this is a really major challenge for the accountants.
Mr. Bimal, one more question with respect to the consolidation. So once we consolidate and make a special purpose financial statements, is the how do we determine the intercompany transactions, especially the arm's length determination and the transfer pricing provisions? So is it mandatory still the group need to follow the transfer pricing within the group, or is there a special provision for that?
See, it is always advisable at the individual level. It is always advisable to follow the arm's length principle. So let us take because at the consolidation level, although these transactions or balances are getting eliminated, but for example, as we discussed earlier, if any of the conditions are not met during that relevant period, then again, the group has to file individual or standalone financial statements. So in that case, these all transfer pricing rules will come into place. So it's always advisable to follow or the transfer pricing rules.
Even within the group, you mean? I mean, say company A and company B have transactions, say sale or purchase transactions between them, and then they're part of one group. So those scenario, once it is group for tax purpose, then we don't need to consider we don't need to follow the ALP rules for such scenarios, right?
Yeah, that is correct. But at the consolidation level, this got eliminated, and we will be filing a single return to the tax authority.
Okay. So this is going to be one of the benefit out of consolidation.
Sure. Yeah, that is one of the benefit. They have clearly mentioned that when you are eligible for a tax group, you need not have to apply this arm's length principle.
ALP and the related transfer pricing provisions as per the corporate tax law.
Correct.
Okay.